Credit is simply spending power pulled forward from the future. When credit expands, spending expands. When spending expands, income expands. When income expands, asset prices expand. That's the engine, and the engine moves in cycles.
Existing home sales fell more than 30% from 2022 highs. Transaction volume, it slowed sharply. That's contraction, but here's the structural reality.
Hey, right now, you're making one decision that could quietly cost you 6 figures or more over the next decade. And you don't even realize it because you think you're being safe.
Tommy?
Yeah.
It's all good. Everything's clear.
That's a relief. That's a relief.
You think you're being patient. You think you're waiting for clarity. But historically, waiting has been one of the most expensive strategies in housing.
Yeah, let's ground that into data. From 2020 to 2022, home prices rose more than 40% nationally. From 2012 to 2022, many markets more than doubled. And after 2008, prices fell roughly 30%. But by 2012, the recovery had already begun. And the people who waited for certainty, they paid dramatically more.
Tommy, what's going on?
I think Tommy's lost his mind, Charlie.
Well, it's honest work, Curly. I don't want to get used to it.
Cycles move whether you move or not.
So here's the uncomfortable question right now. Millions of people are standing on the sidelines, waiting for the signal, waiting for rates to drop, waiting for the market to feel safe again, because they believe waiting protects them. But what if waiting isn't protecting you at all? What if the people who build real financial security aren't the ones who wait for certainty, but the ones who position themselves while everyone else is still waiting for permission? And the most dangerous question of all this, are you positioning yourself like today's theme, Tommy Shelby, with Peaky Blinders?
For what we are about to receive, the Lord make us truly thankful. Amen.
I'm not here to eat. I'm here to do business. What I have to say can be said before the main course, and I will leave you all to your evening.
Or are you the one he's positioning against? Because by the time the signal feels safe, the advantage is already gone.
Yeah, so let me ask you directly. Do you understand debt cycles? Do you understand the 4 phases of short-term debt cycles? Do you understand how media amplifies fear during contraction? And do you understand what phase we're in right now? Because if you don't, this episode is exactly for you. Today, we're breaking down the economic engine, the economic machine with the 4 phases and where we are right now, and what positioning actually looks like before recovery begins.
Behavioral finance shows you feel loss is roughly twice as strong as gains, which means fear will always be louder than opportunity. But math is quieter, and math wins. If you want clarity, not headlines, subscribe, share this with someone who needs to hear it, because understanding the phase before you act is the difference between positioning and paying the premium later.
By order of the Peaky Blinders.
All right, let's get into it. Before we talk about what's ahead in this housing market, and before we try to predict what happens next, we have to look backwards. Because if you don't understand the pattern behind you, you won't recognize the opportunity in front of you. And when it comes to real estate, history doesn't repeat itself exactly, but it absolutely rhymes. So let's start with 2008. Not because it's where we're going to go again in the same way, but because you need to understand why it happened and why structurally it should never unfold that way again.
The great housing crisis of 2008 was massive, and it made ripple effects that we still feel today. Between 2007 and 2011, national home prices fell roughly 30% from peak. Foreclosure filings surged over 2.8 million in 2009 alone, and more than 13 trillion in household real estate wealth evaporated completely. That was real damage. But here's what caused it. It wasn't just home prices fell. Not even close. It was a systematic risk, loose lending standards, no doc and stated income loans paired with subprime mortgage packaging, and banks leveraging mortgage-backed securities far beyond sustainable levels. Credit was being handed out without verifying the ability to repay.
And when defaults began, the entire financial system cracked. The structure doesn't exist today. Post-crisis reforms changed underwriting dramatically. Ability to repay rules were implemented. Capital reserve requirements increased. Risk layering was tightened. The 2008 collapse was built on unstable lending. Today's market is built on far stricter qualification standards. That all matters, but because understanding why something is broke helps you understand why it doesn't break twice the same way. But here's the part that matters for positioning. Even with all that fear, even with all that wealth destruction, most people waited. They waited for stability. They waited for confirmation. They waited for the media to declare, the bottom is here. But from 2012 to 2022, home prices nationally rebounded sharply, with many markets more than doubling in value. The families who bought in 2011 or 2012 weren't comfortable. They were positioned. The families who waited until 2015 or 2016 because it finally felt safe, they paid 30 to 50% more for the same exact home.
Yeah, now fast forward to 2020 when the pandemic hit, right? The 30-year mortgage rate dipped below 3%, oftentimes 2%. For the first time in history, money was historically cheap. But the headlines, they warned of price crashes, mass inventory waves, economic collapse. Instead, from 2020 to 2022, national home prices, they rose more than 20% year over year in multiple major metros. Competition surged, inventory tightened, and by 2023, mortgage rates had climbed from the low twos all the way to the upper sevens. People who waited for prices to drop ended up facing higher prices, more competition, and dramatically higher borrowing costs. Waiting didn't protect them, it simply priced them out.
Yeah, like Anthony said, then came 22 and 23. Inflation just surged. The Federal Reserve raised the rates in the fastest pace in decades. The 30-year mortgage moved from roughly 3 to 7%, close to 8% in under 2 years. One of the sharpest moves we've seen in a generation. And again, buyers froze. I'll wait to see rates come down. I'll buy when things normalize. But here's the pattern that history keeps showing us. When rates ease, demand floods back. And when demand floods back, prices respond.
Yeah, this is an opinion. That's supply and demand. Certainty has a cost, and you don't pay for clarity with stress, you pay it with price. So before you try to say, okay, let me predict what happens here next, ask yourself, is waiting protecting you, or is it just delaying your positioning?
I like this place. Fire for melting silver, canal to get it away. How much?
Nothing you see here is for sale, Mr. Gold.
Oh, everything is for sale. Everything.
We're gonna spin a coin for your yard, Charlie.
Going to what?
If it's heads, I'll be here, takes all of this, with my blessing.
Tommy.
And if it's tails, I fuck your daughter, Mr. Gold.
All right, folks. Segment 1 showed you the historical scoreboard. Now we need to understand the machine behind it, because today's markets don't move randomly. They move inside what Ray Dalio calls the economic machine. And the machine runs on one thing, credit. Credit is simply spending power pulled forward from the future. When credit expands, spending expands. When spending expands, income expands. When income expands, asset prices expand. That's the engine. And the engine moves in cycles.
Yeah, Dalio separates it into two major cycles. The long-term debt cycle, which can last anywhere between 50 to 75 years, which is basically a lifetime for most. And then there's the short-term debt cycle, which typically lasts 5 to 8 years. The short-term cycle, that's driven primarily by interest rates. When rates are lower, borrowing increases. When rates rise, well, borrowing slows. That's tightening, and it creates contraction.
And the short-term cycle always moves through 4 phases: expansion, peak, contraction, and recovery. If you understand these 4 phases, you'll stop reacting emotionally, and you'll start recognizing positioning windows. Let's define them simply. Phase 1, expansion.
Expansion is when money is cheap, rates are low, and credit is easy. Borrowing increases and spending increases, asset prices rise, and the confidence is super high. From 2012 to 2019, we were in this expansion phase. Mortgage rates hovered roughly between 3.5% to 4.5%. Home prices, they rode steadily. And then in 2020 and 2021, we see supercharged expansion. The 30-year mortgage rate dropped below 3%, and the national home price rose more than 40% between 2020 and 2022. That was late-stage expansion.
And here's where media starts to matter. During late expansion, you often hear bubble narratives because rapid appreciation feels unstable, even if supply and demand math supports it. Fear sells. Facts are boring, but structurally, low rates plus low inventory equals upward pressure on prices. That was math, not mood. Phase 2, peak. Peak is when expansion overheats. Debt growth accelerates, inflation rises, the economy runs hot, and policymakers step in. Peak doesn't feel scary, it feels expensive.
Yeah, and then by 2021, inflation surged above 8% year over year. The Federal Reserve began tightening aggressively. That marked the shift from peak into contraction. Now we're in phase 3 of contraction.
Contraction is when borrowing becomes expensive, rates rise, credits tighten, and spending slows. Transaction volume, it just falls, and confidence drops off the planet, and the media tones turn very negative.
Beginning in 2022, the 30-year mortgage rate moved from roughly 3% to over 7% in under 2 years. Existing home sales, and I say sales, not values, dropped more than 30% year over year. Transaction volume, it slowed sharply. That's contraction by definition. But here's the key distinction. In 2008, contraction became collapse because delinquency rates exceeded 10%. Underwriting standards were weak. Leverage inside banking systems was extreme. But today, delinquency rates remain historically low. Most homeowners, they're locked into fixed rates below 4%. Homeowner equity levels are significantly higher. They're massively swimming in equity that surpasses pre-2008. And household debt exceeds $17 trillion. But mortgage underwriting now requires verified income, verified assets, and regulated debt-to-income thresholds. This is contraction inside a structurally stronger system, not systemic failure.
And during contraction, the herd freezes. Behavioral finances explains this. Loss aversion causes people to feel losses roughly twice as strongly as gains. So when rates jump from 3 to 7%, that's emotional shock. It feels catastrophic. Even if structural fundamentals remain intact, the media amplifies that emotion because fear captures attention. All right, phase 4, recovery. Recovery begins when tightening slows, inflation cools, and rates stabilize and eventually ease. Recovery does not begin when headlines turn positive. It begins before that.
Yeah, historically, when rates ease after a tightening cycle, demand that was rate constrained re-enters the market. And because the U.S. remains underbuilt by an estimated 3 to 4 million housing units, price pressure returns, not because of hype, but because of supply and demand. Where are we now? 2026. What do you got, Manley?
So we are in 2026, and we are in late contraction, early stabilization, which is the bridge between contraction and recovery. Rates remain elevated compared to 2020, but inflation has cooled from its peak levels. The pace of tightening has slowed, and credit is tight, but the system still is stable. That is stabilization.
And here's the pattern. During expansion, media warns of bubbles. During contraction, the media warns of collapse. But during stabilization, they turn their tune into cautious. During recovery, they just seem optimistic. The herd moves during recovery. The informed, they move during stabilization.
Hey, you're past. 2012 to 2021 was expansion. 2021 was peak. 2022 to 2025 was contraction. Your present, 2026, it's stabilization. Your likely future. Recovery typically follows stabilization, which means demand is reactive. and increases the competition.
Yeah, but when we look at all of this, Manly, we know that debt cycles, they're mechanical. Media cycles, they fall on emotion. Herd behavior is psychological. When you understand the phase, you recognize the shift before the crowd does. And positioning happens between contraction and recovery, not during expansion.
All right, segment 1 showed you the scoreboard. Segment 2 showed you the machine and where we are right inside it, which leaves only one thing left. If we're stabilizing before recovery, what do you do right now?
I want to suggest that from now on, you contract out your racetrack security to the Peaky Blinders. We'd be saving you a lot of money, Mr. Kimber. In return, you give us 5% of the take and 3 legal betting pitches at every race meeting north of the River Severn, rising to 6 after 1 year if we are all satisfied with the service. What do you say, Mr. Kimber?
I say you talk business to my accountant. I want to dance.
All right, let's slow this down because segment 2 gave you the machine. Now segment 3 gives you the mirror. Every phase of the short-term debt cycle creates a feeling. That feeling drives behavior, and that behavior has consequences. So let's walk through the 4 phases again, but this time through the lens of how you felt and what that feeling made you do.
So let's talk about phase 1 expansion. Expansion feels safe. Rates are low, credit's easy, home prices are rising. From 2020 to 2022, national home prices rose more than 40%, and mortgage rates, they were under 3%. The feeling, it was confidence, it was optimism, it was FOMO. The behavior, multiple offers, waiving inspections, paying above asking price, stretching on the budget. You remember that? The consequences, leverage disappeared. Negotiation power, it shrank. And prices, they accelerated. Expansion rewards action, but it punishes impatience. That gets us to phase 2, which is the peak.
Peak feels justified. Everything is expensive, but it still feels normal because appreciation, being consistent, the narrative says, this is just the new baseline.
That's right. And in 2021, inflation surged, again, above 8% year over year. The debt growth, it accelerated. And the system overheated. The behavior at peak, stretching budgets, locking high prices, assuming low rates would remain. But the consequences, when tightening began, affordability shock hit, and it hit fast. Peak punishes excess. Plain and simple. Which gets us to phase 3, contraction.
Contraction feels dangerous. Rates moved from roughly 3% to above 7% in under 2 years. We keep repeating that because it was scary. At some points, it hit 8%. That kind of move, it feels super dramatic. The headlines get louder. The herd gets quieter.
Existing home sales fell more than 30% from 2022 highs. Transaction volume, it slowed sharply. That's contraction. But here's the structural reality. The U.S. remains underbuilt by approximately 3 to 4 million homes. Delinquency rates remain historically low. Most homeowners are locked into rates below 4%. That means forced selling, it's limited. So this contraction, it's volume driven, not collapse driven. The feeling, uncertainty, the behavior, waiting, freezing, looking sideways, the consequence of waiting in phase 3. You preserve emotional comfort, but you delay leverage. Because phase 3 is where negotiation power exists, not phase 1.
Now let's talk about phase 4 recovery. Recovery feels obvious. Rates ease, media tone shifts positive, confidence return. And when confidence returns, so does competition.
Historically, when mortgage rates decline even around 1%, application activity increases because affordability improves. Demand that was rate constrained now re-enters. And because supply remains tight, price pressure increases. That's not hype, that's supply and demand. The consequences of waiting until phase 4. You compete again, and negotiation leverage shrinks. Recovery rewards those who moved earlier.
Now let's stack the phase clearly. Expansion, confidence high, leverage low. Peak, risk high, denial high. Contraction, fear high, leverage high. Recovery, optimism high, but competition is high. We're in late phase 3, early stabilization, before phase 4 begins. That matters because behavior feels safe in phase 3 often becomes very expensive in phase 4.
Yeah, a mortgage rate, it can be refinanced, but a purchase price, it cannot. If phase 4 brings lower rates, refinancing becomes possible. If phase 4 brings increased competition, higher pricing is likely. Securing an asset in phase 3 preserves optimally for phase 4. Waiting for phase 4 just reduces leverage. Simple as that.
So now here's the peaky lesson. Tommy Shelby doesn't move on emotion. He studies consequence before he acts, because once you make your decision, you'll live with it. And if you buy an expansion, you compete. If you buy a peak, you stretch. If you buy in contraction, you negotiate. If you wait for recovery, you compete again. And historically, the longer you wait, the more expensive homeownership becomes, because recovery restores demand, not discounts. So here's the clean summary. The phase determines the feeling. The feeling determines the behavior. The behavior determines the consequence. We are in phase 3, approaching phase 4. That's the window. The question is not, how do I feel? The question is, do I understand the consequences of waiting? Because in housing, time rarely rewards hesitation.
I do not see how.
And put them on. Put them on your face, or it'll be your eyes that are broken. And please don't imagine that I won't use this minute to do it, or that I am afraid of your prayers or your crosses.
You see the world broken, like those beaten children will.
Now look at me.
Look at me!
Funding withdrawn.
Now it's time for the ever-popular Rate Tracker segment, where we look at where rates are trending and, more importantly, whether we're still on track to hit our beginning of the year projections. At the start of 2026, I projected the 30-year fixed would land around between 5.25 and 5.5. Anthony, he came in much lower, between 4.75 and 5.25. Let's see where he stands now.
So here's the board. The 30-year fixed rate is sitting at 6.04%. The 10-year treasury yield is sitting at 4.043%. Now rewind to January 2026. Rates opened the year slightly higher, and we've seen a modest stabilization into February. But we're still sitting above 6% handle right now, which keeps us in the late phase of phase 3, early stabilization. Not yet phase 4 of recovery for us to see a true 4 handle on a mortgage rate. The 10-year yield would likely need to drop an additional 1% from the low 4s into the low to mid 3 range. And given current inflation trends and economic data, even with potential Fed chair changes or balance sheet adjustments, I just don't see that magnitude of a drop happening in 2026, Manly. So I'm making a breaking news adjustment right now, and I'm moving my year-to-end target slightly from 5.125 to 5.375. Still under you, Manly, but more realistic given the yield pressure.
Yeah, so bottom line, Anthony is repredicting his prediction. And rates are stabilizing, but not collapsing. Phase 3 is cooling, not reversing. We're watching the 10-year closely because that's the lever that determines whether the recovery accelerates or stays gradual.
Yeah, at the end of the day, as this data comes in and keeps coming in, we're making assumptions that are going to be more in tune with what's reality. And although all of us, including you and me, would love to see a 4 handle on the rates this year, given what we're looking at, even with sizable changes, I just don't see it happening. We will get to the rates of 4%, but not this year. In my opinion, probably in the next 15 to 24 months, but at least for this year, the runway shows a 5 handle, but I'll take a low 5 handle any day from the 6s and 7s that we just came from.
Yeah, you're right, Anthony. Good recovery. There's mathematical reasons why it's probably not probable, so keep with the prediction. Good job.
Spent a long time waiting for the cavalry, mate. One time, me and my comrades waited 3 days. The cavalry finally came, an officer on the back of a fine white horse. Joked that he'd been delayed playing a game of whist. So I took out my Webley revolver and I shot him in the head, stole his horse, reported him for cowardice, all for a game of chance. After my people completed their task in Chinatown, they collected all the photographs, letters and checks that were causing you concern. I now have them in a safe place. On Monday, you will give me the full £50,000 in cash, or I will steal your white horse from under you.
All right, folks, it's buzzword breakdown time. Peaky Blinders edition. Rapid fire with producer Ryan. He's back, flat cap on, ready to go. Let's do it.
By order of the Peaky Blinders, 5 words, quick answers, and tell them when it happened. Anthony, you're up first. Expansion.
Expansion, that happened 2012 through 2019, then supercharged in 2020 through 2021. Low rates, prices up over 40% from 2020 to 2022. The confidence was high, but the leverage, it was super low.
All right, next up, Manly, tell us about peak.
Hey, I got my notes up here just for just in case, but that happened in late 2021. Inflation was over 8%. Everything felt expensive, but still normal. It was risk building time.
All right, term 3, contraction. Anthony, tell us.
Contraction, that was just recently, 2022 through end of 2025. Rates jumped from 3% to above 7%. The sales volume fell by over 30%. The fear was high, and the leverage, it was improving.
All right, Manly, tell us about stabilization.
Hey, right now, producer Ryan, that's 2026. Rates are cooling. Inflation is moderating. Uncertainty is still loud, but the opportunity, it's quietly there.
All right, final term today. Anthony, tell us about recovery.
Yeah, I mean, that's the next phase, right? When rates ease, demand reactivates and competition rises. And the prices, they're going to respond. This is what we're going into.
All right, so what phase are we in?
We're in late contraction, early stabilization.
Yeah, it's a positioning window, right, Manly? It's before the recovery. That's exactly where we're at.
Whoa, Tommy Shelby has left the building. Have a great night, producer Ryan.
The nature of the deal is explained in my proposal. I've booked you a suite at the Midland Hotel. If you need anything in this city, just mention my name.
So you want to impress me, Mr. Shelby?
Isaiah? Also in the envelope is a cheque for £500 for your wife. She can use it to buy a black dress, and a black horse with black feathers, to pull a black carriage with your body in it, should you break the terms of the white flag. Now, please, enjoy the city. It's my honor to represent.
So here's the bottom line. Debt cycles are mechanical. Phases repeat, emotions changes, but math doesn't. We're in late contraction right now. Early stabilization, but before recovery. And positioning happens before it feels obvious. Hey, if this episode gave you any clarity, like it, share it, subscribe. Because this isn't about hype. It's about understanding consequences before you make your move.
And remember, a rate, it can always be refinanced, but prices, they cannot. Phase awareness beats crowd emotion every single time.
All right, before we go, Anthony, you're officially a grandfather, so I have to ask, have you started pricing a 30-year fixed pacifier yet? Or are you locking that baby into an adjustable diaper?
First of all, grandfather sounds aggressive. Second, the baby credit profile is already better than most adults. And I'm teaching phase 3 discipline immediately. No expansion behavior in this household.
So you're saying no peak level spoiling?
Stabilized spoiling only with long-term appreciation strategy.
There you go. From housing cycles to diaper cycles. Same rules applies. Understand the phase before you act. Hope to see you next week.
Girl from the heart of Wisconsin to the way that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast.